Hello, I'm Elisa Zhang, and I'm a physician as well as a life and money coach. So today I'd like to talk about just how important it is to invest and be in the market and not worry about timing the market. So I found this great article, which actually ran some numbers, and that really gets the point home. So what they did was they actually looked at putting $2,000 invested each year from the year 2000 to the year 2020, and they ran different scenarios. The first scenario was what's called perfect market timing. So you always bought every year at the lowest day of the market for the year and put all $2,000 in at that lowest day. Next was invest immediately. Basically, invest on January 1st of every year, the $2,000 you have to invest for the year. The third was dollar cost averaging. So they divide the $2,000 into 12 equal payments and invested on the first day of the month every year. So investing in January, February, March, throughout the month, on the first month, invested 1/12 of $2,000. Then they did bad timing, where basically the $2,000 was invested on the day where the stock market was at the highest each year, right? You generally want to buy low and sell high. So in this case, someone who was basically the opposite of great timing, bad timing, always buying at the high of the peak of the market every year. And then the last scenario was just stay in cash and not invest at all. So what were the results? How much money did each group have after 20 years of investing $2,000 a year? Well, let's take a look. So these were the results. Someone with perfect timing investing $2,000 a year for 20 years on the best day of the year to invest when the market was at its lowest had a result of $151,391, which obviously is going to be the best result, right? This is perfect timing, but in reality, no one can really do perfect timing. No one's going to know when the highest day of the market is every year. The second person just did invest immediately, or the second group was invest immediately. And they actually did the second best at making $135,471. And that's probably because the stock market typically goes up more than it goes down. So if you buy immediately as you have the money, then there's a better chance that the stock market will go up with time than it goes down over time. If you look at the dollar cost averaging, where it was invested a portion of the money every month at the beginning of the month, it didn't do quite as well as invest immediately, but, it's still pretty well, $134,856. So less than $1,000 difference. So if it pains you to put a lot of money in all at once because you're fearful that the market goes down, go ahead and do the dollar cost averaging if that makes you feel better, but just automate it. Make sure it happens because you don't want to just forget and not invest. You want to get the money in the market if it's money that is designated for, your long-term goals like retirement, and you've got a long time horizon. But even with bad timing, even with buying at the highest day of the year and having the worst luck, you still made $121,171. And, while that's not quite as good as the dollar cost averaging or invest immediately, which is available to all of us, no one's also, just like no one can have perfect timing, no one's going to have bad timing, always buy the worst day of the year. But look what happens if you just stay in cash. Then you only have $44,438. And that is a huge difference, right? So that is the difference of really growing wealth and just having your money lose value over time because you've invested $2,000 a year over the 20 years, that's $40,000 invested, and you only have $4,438 to show for it, which during that time period is less than probably the inflation weighted money that you put in. So remember, even bad timing trumps inertia. You want to be in the market. You want to invest regularly, and invest when you have money. So even in this down market now, consider investing, do the dollar cost averaging that makes you feel better. And honestly, that's usually what we do for retirement, right? We usually have money taken out of our paychecks to go into our retirement accounts. And that's essentially dollar cost averaging because we're putting money in with every single paycheck. But stay in the market. You want to buy low and sell high, and corrections are a time to get stocks at a bargain, right? These stocks are buying companies that are still producing services, producing products, and people are still buying things. So even though it may not be as high as it was before, eventually these stocks will go up as these company valuations do go up with time. I hope this was helpful for you. Please subscribe so that I can bring you more videos just like this. If you would like to work with me, you can sign up to have a consultation call at www.growyourwealthymindset.com. I can help you start investing, get over your fear of investing, and I can help you actually make goals towards your investing, look at the different timelines for your goals, and guide you on how to invest towards those goals. And that investing doesn't have to be in the stock market. It could also be with real estate. It could also be looking at venture capital funds, but we can talk all that over and look at your current situation and your risk tolerance and how you want to approach building your wealth. So that's what I do. I help people build their wealth and turn a high income into high wealth. Thanks so much for watching.